Hello everyone, this is Michael's Fortune Bread, your US stock market explorer. 2025 will be an exceptional year for the US stock market, a year where we ordinary people can achieve a qualitative change in wealth. It could even be said to be the only opportunity for us ordinary people to leverage the dividends of the times without having to start a business. Now, this opportunity is very close to us, and how to seize it will be the key to investing in the US stock market in 2025. Welcome new friends to subscribe to my channel. In the last video, I analyzed the investment outlook for the US stock markets in 2025. We said that the investment logic of the US stock market in 2025 will undergo a huge change. Previously, the most important factors were macroeconomics and the Federal Reserve. But these will take a back seat, while Trump's policies will come to the forefront, becoming the decisive factors influencing the US stock market trends in 2025. Under this background, the US stock market will have strong upward momentum, but will also encounter greater volatility. However, whether it's the support of the macroeconomy or the stimulation of Trump's policies, these are just ordinary benefits of the US stock market. They can help you make money, but they can't help you become wealthy. If you want to achieve a qualitative change in investment, if you want to accumulate your first pot of gold in 2025, then today's trend that we will discuss is something you must understand. This is AI. Next, I'll explain in detail how the AI concept will impact the US stock market in 2025 and what opportunities exist. Additionally, as this video is the second part of the previous video, we will also address the issues left over from last time, namely, what risks in the US stock market in 2025 should we pay attention to? At the end of the video, I will also provide a clear 2025 investment logic to guide our investments throughout the year. What impact does AI have on the US stock market? You might think that aside from boosting companies like Nvidia, does AI really have that significant an impact on the entire US stock market? Here you can look at the changes in US productivity given by the US Congressional Budget Office. You can see that since 2023, US productivity has seen a rapid rebound. But you must understand that during this period, the Federal Reserve kept interest rates high to control inflation, and the economy was still under tremendous pressure. According to the usual economic cycle patterns, it would be good if productivity didn't decline, so how could it possibly increase? Looking back now, there are many reasons for this, but the sudden emergence of ChatGPT definitely played a very critical role. You might not buy this conclusion now, but that's okay. We can look at a research report from Morgan Stanley. They found that since the advent of ChatGPT, companies that utilized AI for cost reduction and efficiency improvement significantly outperformed those that didn't use AI, and the gap is widening. What does AI cost reduction and efficiency improvement mean? It means that AI truly brought about changes in corporate profitability. In other words, it improved corporate productivity. So you see, AI is no longer a vague concept. It has already started to play a role in the real economy. And this role is just beginning. By 2025, I believe AI will become a truly trend that transcends economic cycles, bringing undeniable improvement to the US stock market and even the entire US economy. In fact, we can already see some practical effects of AI in the current US stock market. The first observed effect is that AI brings cost reduction and efficiency improvement to enterprises. For example, Walmart, a traditional retail company, has already used AI to bring about substantial changes. Walmart has successfully processed 850 million items of product information using AI. What used to require 100 people can now be done by one person. Walmart also uses AI to predict market demand, optimize inventory management, greatly improving its sale efficiency. Additionally, Walmart provides AI assistance to internal employees, helping them optimize recruitment and employee retention, and enhance operational efficiency. This year, Walmart's stock price has doubled, and AI has been a significant contributor. The retail industry isn't the best field for AI optimization. The software industry is actually the most optimized by AI. This is because coding is an area where AI can most easily improve efficiency. Take a look at the gross profit margin and operating profit performance of Salesforce, ServiceNow, and Shopify. Gross profit margin reflects the product strength of a company, while operating profit reflects its operational efficiency. You can see that these three software companies have all significantly improved their operational efficiency recently, even though their product strength has remained relatively unchanged. And if you look at their stock prices, they have all experienced significant growth recently. Of course, you can't say that all of this is due to AI's cost reduction and efficiency improvement, but AI has definitely played an indispensable role. Imagine if AI can reduce costs and improve efficiency for Walmart. Can Costco achieve the same effect? If Shopify can improve its operational efficiency through AI, can Amazon do the same? The answer is yes. AI cost reduction and efficiency improvement have two main benefits. First, the threshold is not high. Anyone can use it as long as they have some development capability to achieve the desired effect in a specific field. Second, its application range is very wide, whether it's retail or software, healthcare or government. Although the difficulty of optimization varies, ultimately everything can be optimized. Therefore, even if some companies are leading and some are lagging behind, it doesn't matter. The trend of AI cost reduction and efficiency improvement will continue to spread across all companies in an orderly manner. In 2024, only a few companies noticed the changes brought by AI cost reduction and efficiency improvement. By 2025, I believe this will become a mainstream trend, where we will continuously see improvements in corporate operational efficiency and profit growth. This will not only enhance the valuation of individual companies, but also collectively boost the performance of the US stock market, ultimately transmitting these benefits to the real economy and stimulating the overall US economy. However, it is important to note that AI cost reduction and efficiency improvement is more of a one-time benefit. A company's efficiency cannot always increase, and costs cannot always go down. Moreover, AI cost reduction and efficiency improvement do not build any new barriers for the company. So while AI cost reduction and efficiency improvement are worth being optimistic about, investors should also view their effects rationally. Have you noticed that the current stage of AI is very similar to the early days of the internet? In the beginning, only a few companies used the internet, like Pizza Hut's online ordering and Wells Fargo's online banking. But eventually, all companies started using the internet to improve efficiency, and the internet brought a qualitative improvement to the overall economy. It seems history is about to repeat itself. If AI cost reduction and efficiency improvement is a multifaceted effort, then AI agents are the most anticipated point of focus explosion concept in 2025. This concept has just recently emerged and has not yet fully fermented in the market. This means that there are still many opportunities left for investors. AI development has three typical stages. The first stage is general AI tools, such as the current ChatGPT large language models. The second stage is customized models that can access company-specific data, which is the method widely used for AI cost reduction and efficiency improvement mentioned above. The third stage is AI agents. The biggest difference between AI agents and the customized models of the second stage is that AI agents can directly make decisions and take actions, whereas in the customized model stage, AI only assists, and humans ultimately make the decisions and take actions. In the AI agent stage, AI takes over this step. Don't underestimate this progress. Once AI agents can replace humans, it means they can execute tasks 24/7 without interruption, leading to a qualitative change in corporate operational efficiency. For example, take the process of customer service handling refunds. With a customized model, a human customer service representative needs to search for a solution in the AI model after receiving a refund request, then respond to the customer based on the AI's guidance, decide if the refund conditions are met, and finally execute the refund. While AI can optimize efficiency in this process, it still requires human involvement for 8 hours a day. With an AI agent, the entire process no longer needs any human participation. The AI will collect requests, find solutions, respond to customers, decide if the refund conditions are met, and execute the refund all on its own. The applications of AI agents go far beyond customer service. Currently, AI agents can already be applied in supply chain management, logistics coordination, financial audits, customer consultations, marketing strategy arrangements, and more. The potential application areas in the future will certainly increase. Recently, OpenAI's Chief Product Officer Kevin Weil said that 2025 will be the year AI agents become mainstream. Additionally, large software companies like Microsoft, Intuit, and Salesforce have all recently released their own AI agent products, and they all stated that AI agents will become the core development direction for future companies. Thus, the concept of AI agents in 2025 is very likely to become a major trend driving the US stock market. So, what does this mean for us investors? Firstly, the biggest role of AI agents is actually in cost reduction and efficiency improvement, just like the overall promotion of the stock market and beyond cycle economic growth mentioned earlier. Secondly, compared to customized models, AI agents have a slightly higher threshold. Not only is the application threshold higher, but the service provision threshold is also relatively higher. Therefore, in 2025, AI agents might not yet achieve full popularity. However, for the fields they can touch, especially the companies providing these services, the effects will be immediate and could bring explosive growth opportunities to companies. Thirdly, AI agents are not yet fully noticed by the market, leaving many potential opportunities to be discovered. Even for existing opportunities, Wall Street finds it hard to quantify their impact, as they have not been seen before. Hence, related opportunities may exceed market expectations and bring higher than expected returns. However, because they have not been seen before, this area also carries relatively higher risks. The impact of AI on the US stock market is not just about cost reduction and efficiency improvement. The stock market has never been a place that follows rules. It is filled with madness and greed. And in 2025, the speculation around the AI concept might become a huge upward risk for the US stock market. Pure concept speculation is hard to sustain, but concepts like AI, which have both imaginative space and actual performance improvement, are the easiest to generate sustained bubbles. Coupled with the overall macro environment and Trump's policies analyzed in our last session, which actually favor the stock market, bubbles are something we must pay attention to right now. In fact, the current market is still relatively rational about AI. Stocks rise with favorable news and fall if the good news is not fulfilled. However, the situation in 2025 is uncertain. If AI develops step by step, I don't think there will be too many problems. But if the development exceeds expectations, which I believe is very likely, then 2025 might be the beginning of the AI bubble. Overall, the impact of AI on the US stock market in 2025, I believe, will include three key points. First, cost reduction and efficiency improvement brought by AI in 2025 will be significant, becoming a huge incremental beyond the economic cycle. This will not only bring actual performance improvement to companies, but will also benefit a wide range. Second, AI agents will become an explosion point that must be focused on. Both companies applying AI agents and those providing AI agent services will see considerable improvement. Third, if AI development exceeds expectations, it may trigger a bubble, which is a major upward risk in 2025. Here, I've analyzed the three most important factors of the US stock market in 2025: macroeconomics, Trump, and AI. Among these, macroeconomics is the most fundamental support, relatively stable and not likely to cause surprises. Trump will be the main variable in 2025, bringing overall upward momentum, but also greater volatility. The most important factor among these, I believe, is AI. It is the true incremental beyond the economic cycle, and the main reason for my optimism about 2025. In summary, I boldly predict that the S&P 500 could reach 7,000 points in 2025. If the AI bubble really occurs, there will be even higher upward potential. Seeing this, you might be eager to start investing in 2025. However, I must remind everyone to also focus on risk control, no matter how optimistic the outlook. So, what risks should we investors pay attention to in 2025? I guess the first reaction of many people when talking about risk is the high valuation. Indeed, when looking through Wall Street institution reports, many institutions raise the issue of valuation. For this, you can compare the valuation of the 7 major tech companies in the US stock market with the remaining 493 companies in the S&P 500. Overall, the US stock market seems expensive. But if you break it down, you'll find that the expense mainly comes from these 7 major tech companies. And these 7 major tech companies have reasons for being expensive. If you consider their profit growth, the current valuation of these 7 major tech companies is only around the historical average, with trends like tax cuts, deregulation, and AI promoting corporate profitability in the US stock market still has room for further improvement. This means that the denominator of the valuation multiple will continue to increase, so there is room for further valuation adjustment in the US stock market. Again, these few words cannot fully show the whole picture of US stock valuations. If you are particularly worried about this, you must consider carefully and learn more. Of course, I'm not saying that the US stock market isn't expensive. It is indeed not cheap right now, but it's not at an outrageous level either. Simply being expensive doesn't necessarily bring risk. It must be paired with a real risk trigger to cause a true downturn in the US stock market. So, what are the real risks in 2025? The first risk is debt risk caused by fiscal deficits. While Trump's policies are generally favorable to the stock market, his tax cuts will increase the fiscal deficit, and the biggest threat from an increased fiscal deficit is US debt. According to current expectations, the issuance of US debt will significantly increase in the next 2 years, which will inevitably exacerbate market concerns about the sustainability of US debt, leading to a sell-off. This trend has already been happening since Trump took office. We have seen long-term interest rates rising recently, influenced by both the Federal Reserve's slowing rate cuts and Trump's policies. If future US debt pressures intensify, causing long-term interest rates to soar, it will compress the valuation of US stocks, posing a significant threat to the stock market. We saw this happen in the UK in June 2023 and in the US in August 2023, both causing varying degrees of market pullbacks. The second major risk comes from China. We mentioned this in the last video when discussing the US-China trade war. Reviewing the history of the last trade war, we find that the real risk wasn't Trump's actions, but China's countermeasures. Each shock to the US stock market stemmed from market fears of China's retaliation. This time, Trump's stance towards China is even tougher, so China's countermeasures might be stronger, leading to higher volatility in the US stock market in 2025. The third major risk is the recurrence of inflation. If the first two risks are relatively short-term, the recurrence of inflation is the most severe and long-term risk. The current concern about recurring inflation mainly comes from Trump's tariff increases. Although we analyzed in the last video that Trump ultimately won't unilaterally impose such high tariffs to cause inflation, this uncertainty always exists, and we must be prepared for the possibility of being wrong. If inflation recurs, the cost will be very high. Not only will the Federal Reserve have to tighten monetary policy again, but the US economy will also face the threat of another recession, fundamentally reversing the stock market's outlook. Even Trump's economic stimulus policies and AI might not save it. Overall, among these three major risks, the first two are the most likely to occur, but are relatively short-term. If they happen, the short-term pullback might be around 10%. The third risk, while less likely, is very severe. If it occurs, it could completely change the current investment logic of the US stock market. Now that we've fully analyzed the outlook for 2025, the final question is, how should we investors respond to such a market? Firstly, I believe the most important thing in 2025 is to hold on to your investments. Those who experienced the market fluctuations during the 2018 and 2019 trade wars under Trump's administration know that the market can be very volatile. Holding stocks during this time requires a strong mindset. For this time, I believe investors need to be equally prepared. Although the overall trend in 2025 is good, it won't be as comfortable as the previous year's rise. Don't let stock prices lead you by the nose. When your mindset is unstable, feel free to revisit this video. Whether you view it critically or appreciatively, I think it will at least help stabilize your mindset. Secondly, 2025 is also a very good year for buying the dip. Since the overall trend of the US stock market is good, and most risks are short-term, this environment is most suitable for a buy-the-dip strategy. There will certainly be many opportunities this year, whether from short-term pullbacks caused by the trade war or the occasional AI winners, providing good investment opportunities. With the insights from this video, you should be able to find corresponding opportunities in your comfortable field. Lastly, I wish all viewers a happy new year once again. I hope everyone achieves excellent returns on their investments in the new year. If you like my video, don't forget to like, follow, and share. Thank you all.